Hello and welcome back to the Costing and Pricing Learning Program. My name's David Gilchrist and I'm pleased to be presenting Webinar 9 in our webinar series, which looks at solvency and sustainability. Before I do that, just the normal warnings, I guess, in relation to copyright, and remembering that all of these materials are provided as open access materials. People can use them, but you must adhere to the copyright requirements, which include attributing the materials to National Disability Services and Curtin University, as well as not disaggregating the materials. In other words, you're not really entitled to present the materials in piecemeal fashion, but rather as whole seminars or whole webinars. Beyond that, you can use them commercially or otherwise. The other reminder I want to make is, of course, in relation to navigation. The previous webinar, Webinar 8, looked at managing the target price gap, which is particularly pertinent to this webinar, Webinar 9, where we're looking at solvency and sustainability. So in other words, Webinar 9 is a step on from Webinar 8's original look at the target price gap. Our next webinar, Webinar 10, looks at ratio analysis, which is a further refinement of this discussion. I also remind you that, of course, throughout the webinar, the slides are tagged with navigation markers, which are designed to help you to navigate from the webinar back to the seminars and the National Costing and Pricing Framework, as well as the study guide. Make sure you do look at the study guide and the other materials in the Costing and Pricing Learning Program, because at the end of the day, the webinars are really designed to be a small taste of the particular topic and to help you get a view of some of the major elements in relation to that topic, and are not comprehensive. You really need to go back to that study guide and those other materials. I guess in relation to this particular webinar, we're looking at solvency and sustainability, and really the emphasis is on solvency, so how you make sure you can pay your bills as and when they fall due, or rather, in point of fact, when we talk about costing and pricing and our webinars up to this point, really trying to forecast those instances where solvency might be a problem for your organisation. We start off, though, by, I guess, trying to make the maximum stick that profit is not a dirty word. Profit is necessary for any organisation, whether a not-for-profit or a commercial organisation, because it provides for working capital, which goes straight to our solvency question, but it also provides for cash to be able to pay out our deferred cash flows, so things like annual leave entitlements, what we would call the medium-term solvency risks. It also allows for reinvestment capacity for replacing assets, so that medium and longer-term sustainability, as well as the opportunities for innovating and improving or refreshing your services. Innovation and change management both require staff time, but they also require capital. That is, they require cash to be able to undertake those processes effectively. So reinvesting for innovation and change affects your ongoing sustainability, but it does require capital to do that. And again, that capital generally is met out of the balance sheet, and the balance sheet capital is provided by the profits that your organisation generates. And just recapping on the last webinar, of course, not all of your services are going to be profitable, and indeed some services might cost your organisation money to supply. We are not in the business of saying that mission-centric services should be displaced or discontinued if they don't make money, but we are saying at the aggregate level, the organisation needs to be profitable, and reducing that target price gap we discussed in the last webinar in order to ensure your medium and longer term sustainability. From a solvency perspective, you need to ensure that you have working capital to be able to be sustainable in the short term. And we talk about working capital and solvency predominantly throughout this webinar. As part of your need to be solvent, your need to be sustainable, of course you need to undertake in your organisation a financial planning process. Now, most disability services organisations, as well as most organisations in the broader human services and not-for-profit sectors in Australia, are adept and used to developing annual budgets for their organisations, and they use those budgets, as we all know, as control devices and planning devices. In other words, boards and others look at those budgets, look at the actual outcomes as compared to those budgets, and then of course start looking at the extent to which they can explain any variances or need to act accordingly. Under any individualised funding environment, of which NDIS is a very significant example, it is necessary to go beyond the budgeting process and actually enter into a financial planning process. The NDIS effectively is a catalyst for this within disability services organisations, but individualised funding more broadly, which has been accepted by all governments in Australia, requires us to start looking at financial planning aspects of our organisation. Those financial planning aspects, of course, include our budget process and are built from our budget process, but they also include the impacts of our costing and pricing so that we can understand what our target price gap is, which gives us an understanding both at the individual service level and also at the aggregate level what our potential problems are going to be as far as funding our organisation are going forward. But financial planning also looks at cash flows and how our cash is flowing within the organisation, and making sure from a solvency perspective that we have sufficient cash to be able to meet the business's needs on a short, medium and longer term basis. We also need to, I guess, take a more business perspective in that sense in terms of our planning to make sure that we are planning our cash flow and our use of our working capital to best effect for our organisation. And again, that doesn't mean that you discontinue mission services simply because they're not profitable, but it does mean that, if you like, you are intellectually engaging with the financial planning process to make sure that where you do decide as an organisation to continue providing services that cost you money to provide, there is a strategy in place to make good that loss in other areas so that your organisation continues to be sustainable. The financial planning process also looks at the capital requirements your organisation needs. So an organisation, of course, has an immediate working capital requirement to ensure solvency. That's the money that is used to pay the bills as and when they fall due. But you also need to take into consideration how and when you're going to replace assets, how and when you might replace things like your IT systems or motor vehicles, and what amounts of cash need to flow out of the organisation to meet those changeover in assets. How are they going to be funded, and what is the cost to the organisation? Therefore, that is a really important aspect that we typically don't take into consideration in human services organisations from a historical perspective, for which the financial planning process requires us to. The other aspect of financial planning is that it typically extends beyond a 12-month period. So a budget process that we're all used to having typically is for a 12-month process, but a financial planning process really needs to extend at a minimum to 18 months, but probably beyond that to 3 years in terms of the full financial plan, and in terms of cash flow forecasting at least 18 months in advance. So that's beyond the typical budget scheme where we typically look at a 12-month or financial year budget period. In fact, the financial planning period should extend beyond 18 months, as I've said. The main considerations, of course, are you need to ensure you remember your mission and that your financial plan supports your strategic plan in the context of your mission. So the financial planning process doesn't become an end in itself, and indeed profitability doesn't become an end in itself, but it is all there to support your ongoing capacity as an organisation to do what your mission instructs you to do. So the first step in that financial planning process is, of course, to look at your cash management situation. And of course there are, in essence, and this is a very simple way to look at it, but 3 possible situations from a cash management perspective. When we talk about cash management, we are of course interested in the immediate effect because that works to our solvency need, but over that 18-month period we're also looking to identify situations where we might not have sufficient cash to be able to pay our bills and to work out how we're going to respond to that. But you can have three possible cash positions where firstly you don't have enough cash, the second where you have enough cash, and the third where you have too much cash. Now the first one of course is not an attractive option because that is a situation where you are insolvent and you're not able to pay your bills as and when they fall due. That doesn't mean that you have cash lying around waiting for the day a bill comes in, but it means that you've planned sufficiently in advance to ensure that at the time a bill needs to be paid or a obligation needs to be met, you're in a position to actually meet that obligation or pay that bill. So it's not having the cash sitting there all the time awaiting that outcome, but the cash is there at the time it is needed. That is the position where we have enough cash, or in other words, in this context we're talking about working capital. Too much cash might seem like to many to be an interesting concept, and indeed it is a very attractive problem to have for any organisation. It's much better to have too much cash than enough or not enough. But what we mean by too much cash is that where we are trying to reduce our working capital, any excess cash is actually applied either to expansion or changes in the business, innovation or other aspects of improvement, or it is appropriately invested so that the organisation is getting a return on that cash. What we mean about the phrase too much cash in this context is that in fact we need to manage our cash so that we don't have money sitting in a cheque account awaiting the day that a bill comes in. So it's about efficient use of cash is just as important. Your plan of course needs to vary depending on which of these you have, but the key first question that you must have is that over your 18-month to 3-year planning period for your financial plan, have you sufficient cash at all points that ultimately you will continue to be sustainable? Or is your plan suggesting, your forecasting suggesting, that in fact your cash reserves are being chewed up because you're not efficient enough or you're not able to close that target price gap effectively enough to stop cash going out the door? Ultimately, a profitable organisation is an organisation that achieves higher cash flows into their organisation than out of their organisation. So if you're reporting a profit, at some point in future that profit should turn into cash. And that cash is of course then important to make sure that you use that to meet your bills, to be able to fund your innovation and other processes that you might enter into, and also to invest if that's necessary and appropriate. When we're looking at cash flow planning, it is equally important to look at the context of the time frame and particularly the iterations or the number of times you undertake that particular cash flow planning process. So cash flow planning and financial planning is an iterative process. So in other words, it's a process that you continually return to and you continually refine as a result of your new experience. So each month that goes by, you're actually adding a new month to the end of the program, but you're also, if you like, amending your cash flow planning expectations based on the experience of the previous month's operations. So it's said in this slide that the expense planning should be relatively easy. We're looking at our expenses over that period, but incorporating our capital expenses as well, so the amount of money that's going to flow out of the organisation as a result of turning over motor vehicles, replacing IT, or other aspects of assets that need to be replaced. Certainly 18 months is the minimum, as we've said before, but certainly no less than 12 months. You must be very realistic in your cash flow planning, so not conservative or aggressive. So by conservative, we mean that you might emphasise the cash out and de-emphasise the cash in order to be risk averse, or aggressive means that you might actually believe that there could be a major change in terms of net cash inflows for your organisation in a positive sense. Either elements are on extreme ends of a spectrum. We want to get as realistic as possible, and we want to be as comprehensive as possible, but remembering the 80-20 rule that we've introduced in previous webinars, where we do our work to look at the major components that are going to have a material effect, rather than trying to cash flow plan down to each last cent, which doesn't really add to the material value of the planning that you're undertaking. And that you are undertaking. The other aspect that you would undertake to do as part of your cash flow planning, and particularly your reporting of cash flows to boards and others, is to identify the uncertainties and risks that are associated with the plan, the things that you don't understand or don't appreciate what might happen in relation to how things might flow. So NDIS is a classic example where we don't really know where the prices will land or what the ultimate structure of the NDIS might be, certainly in some states around the country where there are likely to be local versions of the NDIS established. But more importantly, that when we look at cash flow planning, we have an idea of the kinds of subjective decisions we've made in terms of getting to that cash flow plan. So when you're actually undertaking your cash flow, you're going to make some subjective decisions about what might happen when, and you need to disclose those to people that are actually looking at the cash flow plan itself. Not all of them, but certainly the material ones, those ones that are going to have an effect in the level of risk and the level of, if you like, comfort people will have in looking at your cash flow forecasts. So in effect, budgeting or forecasting, most organisations still use an annual budget. It's workable within the current funding model, but it's really not appropriate. We need to have a cash flow budget in that 18-month to 3-year period time frame. We also need to look at rolling forecasts. So I foreshadowed this in my previous comments around cash flow planning and financial planning, but a rolling forecast simply means that we continue to update our expectations, and we typically do that 6 quarters out. So in other words, our experience is building our forecasts, and we're continually returning to our forecast to make sure that our experience of reality is reflected in our ongoing expectations. One would hope, and it's not always the case, but one would hope the more experience you apply to your forecasts, the more likely they're going to be zeroing in on the likely outcome associated with the cash flow of your organisation. Remember, detail, as I mentioned before, is only to the relevant level. You need to make sure that you're only cash flow forecasting for those material amounts, and you also need to think about that cash flow forecasting in the context of your ongoing budget requirements and also your reporting requirements external to your organisation. So while the NDIS might still be based on a person-centred individualised funding arrangement where you're paid on invoices in arrears, other funders are still going to have business rules and arrangements that might mean that externally you have to have different information provided to them. Remembering the rolling forecasts, like the budget, like your target price gap analysis more broadly, are all internal conversations or internal documents designed to give you an understanding of your sustainability, not for sharing outside the organisation. Simply put though, a rolling forecast is a forecast that we make of cash flow that extends to 18 months, between 18 months and 3 years, but which we continually update, as opposed to the budget, which is set and which we continue to use and examine in the context of our profit, our actual profit outcomes, but which is not amended. Our budget should be set at the start of the year, and we should be concerned with changes that are occurring in the organisation as a result of that budget process. The other thing that we should always consider is that cash flow is also affected by the relevant range within which we're operating, and therefore the activity level volumes that are deciding, or rather influencing, how we might make decisions about cost allocations to particular units of measurement that we might be providing. In that context, I don't plan to go into relevant range in any depth in this webinar because we have dealt with it in the last 2 webinars, but to remember that if you are on an expansion track, for instance, then you might have cash flow going out of your organisation as a result of the capital required to establish that and build the capacity for that expansion, but also more generally, if you go outside your relevant range, typically that would result in increased costs for overheads and so on, which should be taken into account in your cash flow forecast, the same as they would in your budget, and the same as hopefully they would in the context of your strategic planning process as well. So relevant range is incredibly important for your cash flow forecast too. In terms of those seasonal or other cash flow deficiencies you might identify over the next 18 months or 3 years, depending on how you undertake your cash flow planning. There are, of course, debt finance options that might need to be accessed in order to allow your organisation to weather a particular storm. I guess the key thing about debt finance is we haven't typically used it in the not-for-profit sector for a number of reasons, but one of the main reasons has been that by and large, and this is a very general comment, but by and large, our funding has been provided as grants in advance, which has meant that cash flow has not necessarily been a major obstacle, even for organisations that are technically unprofitable or unviable. Many have survived for many years as a result of having cash flow in advance and being able to, if you like, eke out their existence until they get to that next cash flow point. In the new world, with individualised funding and person-centred care, so under NDIS as well as other funding arrangements in that type of policy model framework, the level of activity combined with the fact that you only get paid on invoice for activities already undertaken obviously dramatically affect the amount of working capital and cash flow timings in your organisation. Therefore, debt finance might be an option for your organisation. Banks are starting to be more perceptive to the idea of funding NFPs, but you need to remember that there are a couple of important aspects to that. Firstly, that of course directors are responsible for any debt finance, and particularly under the ACNC governance regulations, must ensure that they're able to repay the debt, or the organisation can pay the interest and the debt back in due course. Therefore, your financial planning horizon should show when the debt is required, but should also show how that debt is repaid and what the impact of that debt and the interest bill associated with that debt is on your cash flow. In other words, you might choose not to enter into debt finance, and I'll talk about this a little bit more later, in the instance where your cash flow is generally on the decline and the organisation is looking less viable in the medium to longer term. Cash flow lending is possible, but it is something that you need to think about very, very closely in the context of your working capital requirements, as I said. In terms of solvency though, having debt finance can assist with your solvency for short-term periods, and as I mentioned before, you need to be thinking about whether or not your organisation is in a general cash flow decline, in which case solvency ultimately might be a question mark for you, or whether you are just simply debt financing for particular seasonal problems that you might foresee. From a solvency perspective, you do need to be looking at that 18 months to 3 years out cash flow requirements, because solvency cannot be left until you are trading insolvent. Particularly from a director's perspective, there are criminal and other impacts associated with that that they need to be aware of, but also from your client's perspective. A disorderly exit caused because you are in a financial crisis presents not only great inconvenience, but also, if you like, really destroys your capacity to ensure confidence in your clients and in your staff. And therefore, having a forecast in solvency terms and making a decision point about whether or not you want to continue providing particular services from a particular point in time allows you to plan for an orderly exit out of those services. The key question is whether you can meet your debts as and when they fall due for the entirety of the planning period that you're looking at. So not just tomorrow or the next day or a particular point in time, but for the entirety of that planning period. And if there is a general decline in cash flow being shown in that extended planning period, then you really need to put in place significant strategies that you're very confident will turn around that particular problem before solvency hits. So the short answer is, don't leave your solvency decision too late. If you feel that the organisation is on a downward spiral in terms of income, then you may need to make a solvency decision, but do it while you have capacity to deal with it properly and exit services in an orderly manner. You also need to, I guess, refer to the adage that accountants often use in the context of solvency, is that if you do recast your budgets, if you do implement strategies, you need to honestly, openly look at your organisation and work out, well, what is actually going to change as a result of what we've done? Are we kidding ourselves, or is our solvency really able to be dealt with in the context of the strategic changes that we've made to our organisation, the changes in service mix, relevant range, or types of services that we might provide in order to be more profitable and more cash flow sustainable? But of course, ultimately, winding up can be one decision point that the organisation can make. So winding up is on a spectrum from starting at one end of business as usual and not changing anything, through changes to your relevant range, the quantum of activities you provide and the types of activities you provide, through to exiting disability services, but perhaps continuing your services in other human services areas, through to ultimately winding up the organisation. Winding up the organisation is also always better to wind up or to exit services without insolvency, for the reasons that I mentioned when I was addressing the previous slide, not least of which because it gives surety to staff and to clients and gives them confidence that their services will continue to be provided. Remember though that winding up is a valid option. It's a valid option to discontinue service delivery, and at some point in the context of looking at individual services, even though they might be mission centred services, services that are related to your mission, at some point there must be a line in the sand, because a reduction in solvency, a reduction in financial capacity will ultimately be borne out in either a reduction in services in terms of quantity or a reduction in service quality. At some point that becomes untenable for the organisation. Obviously, if your mission's been completed, that is another reason from why you might wind up, and also considering what you do with remaining assets. So winding up in a controlled way allows you to retain as many assets as possible, which might then be passed on to a similar organisation that has a similar mission to yours. Remember, winding up with insolvency is a much more difficult thing. It is a high-risk venture and has some significant impacts on directors and senior staff of organisations. Insolvency and insolvent organisations, or organisations that undertake their cash flow forecasts that suggest, the results of which suggest that they might be insolvent at some point in time, should really get technical expertise and advice to help them through that process and to help them make the decisions associated with the insolvency problem. Okay, so that really concludes this brief look at solvency and sustainability under the NDIS and in disability service organisations. Do go back to the study guide, and particularly the macro case study, to ensure you understand the points that have been raised here, and also explore Webinar 9, which looked at that efficiency problem, and join us for Webinar 10, which is the next webinar, where we look at ratio analysis as a control tool, which will help us to understand our sustainability more fully as well. As always, the Curtin Not-for-Profit Initiative people are very happy to get your comments, your queries, or to talk about additional materials that might be added to the webinar series, or more broadly to the Costing and Pricing Learning Program. Thank you very much, and I look forward to talking to you next time on the Costing and Pricing Learning Program webinar series.